Bloomberg Audio Studios.
Podcasts, radio, news.
You're listening to the Bloomberg Intelligence Podcast. Catch us live weekdays at 10 a.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. Listen on demand wherever you get your podcasts or watch us live on YouTube.
Alix Steele alongside Paul Sweeney and John Tucker. Let's go back to that ISM Manufacturing data, because that ISM Manufacturing read on the employment side was what really preceded that weaker jobs report that we saw in August. So it might set us up then for this Friday and the jobs report. Tim Fiore is chair for the Institute of Supply Management's Manufacturing Business Survey Committee. Hey, Tim, it's great to see you. So is this number good? Is it bad? Is it the same?
Well, good morning. So, I think it's a little bit of a misnomer. So, we came in a little bit lighter than people thought. We're a little bit better than last month. But if you look at the three elements, demand, output, and inputs, the biggest reason for the lack of slowing down even further is the fact that our manufacturing inventory number came up surprisingly. So overall, demand is still elusive. It's hard to find. It's still not there. Okay, fine. Backlog is still contracting, not quite as bad, but still pretty bad. On the input side, we had suppliers delivering a little bit slower, but not a big deal, probably stable month to month. The big surprise there was really manufacturing inventories popping up to 50.5 when it's been historically 48 or less. But I think that's really a timing issue between reduced output and trying to slow down the inputs. Because the real story here is on the output side, with production coming down again for the third straight month, which really means revenue, good surrogate for revenue. And as you mentioned, Alix, the employment numbers is continuing to sag. And in fact, in this month's evaluation, almost 65% of our forced reduction actions were layoffs, which are the highest number we've seen so far.
Tim, when I'm looking at the ISM manufacturing data, what am I looking at? What industries are most notably represented in that data point?
Well, the big six are, your first one is chemical products, and you have transportation equipment. You got computer and electronics, food and beverage. Those two are kind of intermixed. You got fabricated metal products, machinery. And those are the big six. Those make up 70%, 72% of manufacturing GDP. So, they're pretty strong drivers. And if you look at 5 of those top 6, the inventory number actually broke 50, which we haven't seen in probably a couple of years. So I really think it's a timing issue. We weren't able to slow down the inputs as fast as we really wanted. And I think it'll self-correct itself. So if you take that number and you do a normalization of where it would have been based on what was happening last month, you're probably down that same range that we were at last month. So, the summary on this is that don't really see demand coming back before the end of the year. It's a combination of interest rates. We got good news last week, obviously. But there's a lot of other issues here around the election that are really coming to play now. They're really holding back, waiting to see which party actually takes control and how significant that control will be. Demand is the problem, has been the problem. Inputs are kind of overwhelming the output side. The output side is continuing to sag. So not a great story here, but no big surprise. We saw this coming last month. This report pretty much validates where we were last month, and that is that manufacturing is slowing down. It's not in a super dangerous category yet. It's in a yellow area. We had 53% of overall manufacturing GDP contracting, which was better than last month at 84%, I think it was. So, not a great report, but not catastrophic either.
But great insight, and really helps set us up and understand how we are headed into Friday, Jobs Friday. All right, Tim, thanks a lot. Tim Fiore, chair of the Institute for Supply Management's Manufacturing Business Survey Committee. So then it's no surprise that you still have the S&P off by 1.2%. There may be some other factors obviously going on in that, but it also explains the continued dip.
You're listening to the Bloomberg Intelligence Podcast. Catch us live weekdays at 10 a.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. You can also listen live on Amazon Alexa from our flagship New York station. Just say, Alexa, play Bloomberg 1130.
This is Bloomberg Intelligence Radio. We are broadcasting to you live from Interactive Broker Studio right here in Midtown Manhattan. And if you are listening in Boston, our new home starting today will be 92.9 FM, Bloomberg Radio, moving to 929 FM in Boston starting today at noon. So follow us on that. All right, going to the markets here, we're right around the lows of the session. I have read so many notes about how bad September is for equities. I'm very much not surprised by the downdraft today. Grace Lee joins us now. She's Senior Portfolio Manager at Columbia Threadneedle, joining us from Boston, Massachusetts. Grace, do I just, glaze over today and say, yeah, okay, seasonality, whatever, and move on? Or is there something real going on here?
Well, Alix, thanks for having me. I think when you look at August was actually pretty strong. So, when we come back from vacation and people are kind of back to reality and looking at what is historically a not so great month for stocks, I think it's worthwhile that this is not anything to be alarmed about. It's a bit of a breather, and the market certainly needs some of that every once in a while. So overall, not particularly concerned. It's I think it's somewhat normal, and again, there is still green on the screen as well. So it just depends on where people choose to look. So I think there's a number of defensive type names that are holding up just fine even in a tough market today.
In a tough market like today, or just in general here as we head into the last few months of the year, am I still banking on the big tech stocks, Grace, or should I be looking for other areas in the market, other sectors maybe for value?
Yeah, I think as a value manager myself, I always think value is an interesting place. But in particular, given that, I think tech has certainly done very well and continues to post very strong numbers. But I think if you look at some of the estimates for the non-Mag 7 stocks, those are projected to do somewhat better in the second half of the year. And I think we've already seen the broadening of the market, with sectors like utilities and REITs posting double digits in the last couple months. Ever since that big July CPI print came out, I think that really shifted the tone of the market to people looking forward to the first rate cuts.
So before we move on to sort of what other stocks are good, you mentioned tech. However, everyone still wants to own AI. So on days like today, do you buy the dip in NVIDIA, or do you just sort of hold those tech positions of where they're at and then put the new money to work somewhere else, like in consumer staples or something?
Well, I think a lot of people are spending a lot of time wringing their hands over how to be positioned in the big tech stocks like in NVIDIA. I think there's still, I think most people probably have enough exposure at this point. I think it's probably wise to look at the other sectors where people have not, they go to them every once in a while, but I think people need to really change their habits a little bit. It's been a always return to growth, after some of these shakeouts. And, maybe people need to stick a little bit more toward the center or more toward value, especially as we are seeing rate cuts and some of the sectors that have been hurt by that are poised to do a lot better. And that if people are concerned about recession or so, then, you do have a little bit more room in defensive names to hold up.
So, Grace, as a dividend-focused manager, if Tim Cook walked into your office today, what would you tell him about, or what would you suggest to him about a dividend policy for a company that's got, $150 billion in cash on the balance sheet, $100 billion of free cash flow every year? What kind of advice would you give him vis-a-vis a dividend policy?
Well, I think it's up to every management. With that type of cash flow, it's always welcome to have, and I think it does broaden the investor base quite a bit when you have a reasonably meaningful dividend and you're still able to invest plenty in your business in order to grow. But it's a different balance for all types of companies. So, but I think certainly dividend investors would welcome, an increase in any of the big tech names if they wanted to increase their dividends.
I don't know, Paul, what would you say?
I would say give me a 2.5-3% dividend yield, and I've said this to Mr. Tim Cook.
Already said?
I know. I was
Duke
joking.
University campus. I've told him that, and he just kind of brushed me off.
He says, "Oh, okay, thanks, Paul. Bye-bye.
Thanks.
See you later."
Yep.
Okay, so Grace, final word. If I want to get defensive here, what's my best bet?
Well, we still think that some of the real estate stocks actually look pretty interesting. We've been involved, but the other day I looked at a couple of them, and they still look very attractive in terms of absolute historical valuations and and getting the tailwind from rate cuts. They've been probably some of the most pressured names over the last couple of years. So I think, you've got names like Simon Property, which is the big mall owner that is trading at 52-week highs, but is still not extremely expensive, and really is very well positioned overall, and still has, I think, close to a 5% dividend yield. So we think names like that still have room to go.
Grace, thanks so much for joining us. Really appreciate getting some of your time. Grace Lee, she's a senior portfolio manager at Columbia Threadneedle in Boston.
You're listening to the Bloomberg Intelligence Podcast. Catch us live weekdays at 10 a.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. Listen on demand wherever you get your podcasts or watch us live on YouTube.
Happy Tuesday, everybody. Alix Steele here alongside Paul Sweeney. This is Bloomberg Intelligence Radio. We bring you all the top news in business, economics, finance, and politics through our lens of our Bloomberg Intelligence folks. They cover 2,000 companies in 130 industries all around the world. We also tap our deep resources coming from Bloomberg News and print to cover all the top stories. Now, this caught my eye over the weekend. I try to check out when I'm on vacay, but this one I really had to read in because Volkswagen is turning on Germany. That the company is considering factory closures in Germany for the first time in its 87-year history. Not only does it part with this tradition, but risks a feud with unions in a step that truly reflects the heartache that is happening within the European automakers. So we wanted to get more on that with Stefan Nicola, European Automotive Editor, joining us from Berlin, Germany. So many layers to this, Stefan. But are they going to cut factories, or is this like a threat to the government or something?
Well, we don't know for sure, but what we know for sure is that a lot of car makers in Europe are having issues, and Volkswagen is right at the front of that. There is overcapacity in Europe. Car sales never really returned to levels before the pandemic. EV sales growth is slowing, and we have new competitors like Tesla, like some of the Chinese entrants that make their life difficult. So, it could very well be that one or even more factories will have to close.
Stefan, talk to us about that Chinese competition. Give us, because there's no Chinese cars to speak of here in the U.S. Talk to us about how it is in Europe.
Yeah, of course, in the US, the Chinese can't really make an entry because of the tariffs there and the trade tensions. The EU has answered, as you know, with its own set of tariffs. But, the Chinese car makers have started to expand here in Europe since early last year. And the big brands, BYD, MG, which is now owned by a Chinese company, Geely, but also some of the smaller ones are offering electric but also combustion engine cars at discount prices. So they're really, producing very cheaply in China and selling at a quite affordable and competitive price here in Europe. So, they're making inroads. They represent about 10% of new sales. So a significant, competition already. And they have plans to expand more, produce locally even. So, yeah, it's only going to get more intense competition here in Europe.
What I don't understand is my impression of just working in Europe is that unions really rule the roost. I mean, will unions allow this? Like, what's that dynamic?
Yeah, it's a difficult dynamic, to say the least. Unions will fight this. That's obvious. They will try to sweeten any deal. No company in Europe that has a major union presence will be able to do this on the cheap. So Volkswagen will have to pay sort of considerable, payoffs to any workers it will let go. But of course, unions also understand that the European automotive landscape is changing, that labor costs are relatively high in countries such as Germany, but also Belgium, where an Audi plant might go. So it's a fine line that they have to walk, but for sure they will not go down easily on this front, and there's going to be hard negotiations to come in the coming months.
All right, Stefan, thanks so much for joining us. Stefan Nicola joining us. He's European Automotive Editor for Bloomberg News, joining us from Berlin, Germany via Zoom. Again, it looks like tough times in the European. One of the questions I have just thinking about it longer term is, why are they not buying as many cars as they did pre-pandemic? Is that the same here in the U.S.? I mean, I don't know. Oh,
I don't know. Let's see. I feel like I should know this off the top of my head, but I don't.
I know they're not. Yeah, I don't know.
I'm looking.
I mean, what are you doing if you're not buying a car? How are you getting around? I mean. Like me, I go my Vespa scooter up and down the Jersey Shore, as John Tucker knows.
Maybe you just don't have as many. So I'm looking at where we are in cars. We're not where we were pre-pandemic yet.
Yep.
We're definitely not where we were during the spike during 2021, but also not during the pandemic, but not by a terrible amount. I just think it's also more about the cars that they are selling in terms of, say, EVs are just not profitable. So they have to spend all this money and then they don't get the money back. Like, that seems to be sort of the issue and how Germany then deals with it. But that was a story that really caught my eye.
You're listening to the Bloomberg Intelligence Podcast. Catch us live weekdays at 10 a.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. You can also listen live on Amazon Alexa from our flagship New York station. Just say, Alexa, play Bloomberg 1130.
Alix Steele, Paul Sweeney live here in our Bloomberg Interactive Brokers studio, streaming live on YouTube as well. YouTube.com, search Bloomberg Podcast. That's where you'll find us. And if you're listening to us in Boston and in New England, our new home starting today will be 92.9 FM Bloomberg Radio, moving to 92.9 FM in Boston starting at noon today. How cool is that? That's a big stick up there. So that'll be good for our friends up there in New England. Marvin Loh, he joins us, Senior Global Market Strategist, State Street. He's up in Boston. He's all fired up for that move to 92.9. Hey, Marvin, what is it? You're in the marketplace here. I mean, 29 companies hitting the bond market today. What does that tell you?
You know what? I didn't realize that the calendar was that heavy. And it's interesting, right? Especially if you think that the Fed's going to start cutting, that, corporate America, corporate treasurers are just marvelous at really understanding the markets in a lot of ways better than we do, because they're trying to figure out how to deal with their funding costs. There must, and I think we're seeing that in some of the price action, there's got to be an increased amount of recessionary concerns making their way into the market, because for them to want to come in when they know rates are likely going lower must mean that they're worried about access. And that's the telling market narrative, if you will.
So what do you think that the potential for upside or downside is for then? I mean, we have some key risk events, right? So where's the risk profile at this point? Yeah,
for sure. I mean, the data this week is top tier. We're going to get a real perspective on this 25 versus 50. We'll get a sense if bad is good or bad is bad, if you will. I think the real data point that's going to define what this quarter looks like is that jobs number, and whether or not kind of the slowing that we saw at the end of the summer, at least with the July jobs report, which kind of set off kind of the recessionary concerns, is actually the trend. Are we really slowing the jobs market to the degree that that 114,000 print last month indicates? And if we are, then the Somm rule and everything about recession is a legitimate market concern kind of going into the end of the year.
Marvin, for better or worse, it is an election year. How does that typically factor into your calculus, or do you kind of try to put that to the side?
I try to put it to the side. I mean, it's close. We know how heated this election is. The Fed itself kind of changed their November meeting to Thursday rather than Wednesday in the event that the elections created a lot of market volatility. So, you have to take it seriously. The data leads us, however, in terms of what the reaction function from a financial conditions perspective is. So we're more focused on non-farm. We're more focused on what the data is telling us and whether or not what seems like a fairly aggressive rate cutting path that's expected for the Fed this year, 4 cuts this year, potentially might be underestimating the economic weakness. But the data is going to guide us to the answer around that.
So already with 100 basis points, we're looking at 150 basis point cut. It sounds like you're of the mind that we should and maybe have more than that if there's more economic weakness?
You know what? I'm still in the camp that a very methodical one per meeting through the end of the year makes sense. I'm still in the soft landing camp. But in terms of market pricing, if you're not worried about reacceleration of debt, the only other part of the discussion is that the economy performs worse than expected. And from that perspective, I think that the market is going to price in a little bit more and could probably get more aggressive if the data really starts to move in that direction. We're not in the camp of that. We haven't really seen it. The jobs market still looks like it's creating a decent amount of jobs to kind of keep the consumer engaged, but every data point is live.
Marvin, you're a senior global macro strategist. Where do you see the macro opportunities on a global basis these days?
Yeah, I think on the currency side of things, some of this dollar weakness probably went a little bit too far. I think kind of this volatility that we're seeing within the markets are going to provide an opportunity to buy the dollar, at least against maybe some of the higher beta currencies. I think what we're seeing out of Japan is super interesting. UEDA and Japan itself is in a bit of a bind when it comes to inflation. They should have higher rates. So, you kind of hope that doesn't create the amount of volatility that it did earlier this year. But certainly I think that the market is on edge based on that. And really from a rates perspective, if you don't think the Fed is going to be able to be as aggressive as the market is pricing, or if you think that it needs to be more aggressive, that's kind of your call. There definitely is curve trades around it. We're in the camp that curve steepening is still a trade that you could put on, even if the Fed doesn't necessarily reach what the market is pricing right now.
Marvin, I guess my other question, though, is how influential do you think the dollar is going to be to all of this? Because we were talking to Abigail Doolittle. She does technicals. She also does market research for us here. And she was saying that the carry trade could really also be unwinding again with the yen rally. And I'm just wondering, when you look at that global sphere, in addition to the U.S., how much is hinged on it, and how much of is that us just making a big deal out of nothing?
I mean, the dollar is always the most important currency in the world. Our analysis in terms of where we potentially are with the yen carry trade is that most of it's been unwound. So I'm not expecting a lot of volatility to come along with kind of the stronger yen as we see now. It's ultimately one of the harder things to try to figure out in the market. For the dollar not to be important, however, really does have to get towards its position as a reserve currency, more of an intermediate term type of discussion. And, I just don't see the dollar being toppled anytime soon. And U.S. exceptionalism when it comes to our companies and the earnings potential and really the technology advancements that are driven by U.S. corporations still seems like it's intact to me.
Marvin, American exceptionalism as it relates to the economy, is that something you buy? And if so, how does that reflect it in kind of your outlook?
Yeah, I do buy it. I think that, I really think that the companies that are developed in the U.S. in terms of kind of new business models, the ability to find capital, and really an advanced capital market environment that allows companies to not only wind up in the U.S., but really those ideas to incubate in the U.S. is something that other countries, other parts of the world would like to replicate, but they just can't. Some of that's because of the reserve currency. It's the fact that we've got the liquidity that allows that to happen. But, we were talking about NVIDIA. Everyone was talking about NVIDIA pretty much around the world all summer and certainly last week. That business model, it's not an accident that it's here.
Right, totally.
Its founders are not American. And I think that we're going to continue to be able to germinate that type of business model, which really puts the U.S. in a position where our capital flows benefit from that.
Yeah, but we're the ones with the huge deficits. Not that other countries don't, but we're the ones with the ginormous deficit that's not going to be fixed no matter who's in the White House.
Yeah. I mean, it's one of my soapbox issues for sure. I am in the camp that I'm in the camp that Washington needs to get it right. They've got to start to acknowledge it the correct way. And unfortunately, all the actors in Washington have weaponized the concept of the deficit to the point that it doesn't exist. From that perspective, it's going to be up to the markets to ultimately shutter and get them to focus on it. but that doesn't really change the fact that the U.S. still has some advantages that we're going to be able to retain.
All right, hey Marvin.
But higher yields. But I'm sorry. But higher yields are something that we should definitely think about from a longer duration perspective.
Yeah, exactly. Like we're kind of stuck with them for a little bit. Hey Marvin, really appreciate it. Thanks so much, Marvin Loh, joining us from State Street.
You're listening to the Bloomberg Intelligence Podcast. Catch us live weekdays at 10 a.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. You can also listen live on Amazon Alexa from our flagship New York station. Just say, Alexa, play Bloomberg 1130.
All right, Alix and Paul Sweeney live here in our Bloomberg Interactive Broker Studio, streaming live on YouTube as well, so you can check us out there, Bloomberg Podcast. That's how you can search for us. And in Boston, 92.9 starting in just, I'm going to call it 6 or 7 minutes, noon Eastern time, up in Boston. Bloomberg Radio will be on 92.9 FM. How about that? All right, Citadel Securities, Jane Street Group, two of the largest market-making firms in the U.S. are on track for record annual revenue hauls as they further encroach on the big banks' trading territory. Katherine Doherty joins us here. She's a finance reporter for Bloomberg News. She joins us here in our New York studio. Where did these guys come from? Citadel, Jane Street. If I'm Fidelity, if I'm a hedge fund X, I'm calling these guys to do my trades, right?
So a lot of trading isn't happening by phone. And that's part of the story of how these firms have become so prominent. With electronic trading, a lot of it is happening offline or off of the phone. And so these firms are developing algorithms, technology that is helping just facilitate faster trading, and that trading, the pricing is becoming tighter, and the banks are having to compete with these market-making firms because they need to provide pricing that is competitive and gives their institutional or retail investors the best price for what they're either looking to buy or sell.
Well, how much money are these guys like Citadel making off of this? Like, do they care? Is it a lot for them or what?
It's billions. And these two firms are on track. 2022 was record years for both of them, and it's looking like 2024 might beat that record year. So for Jane Street, that's over 10 billion. For Citadel, it was 7.5 in 2022. And that's not close to what the big US banks are making in their trading arms, but it's a significant increase when you just look at the year over year jump. So for Citadel Securities, it was an 82% jump. I believe it was 78 for Jane Street. So just the growth is extraordinary, and the banks are starting to look over their shoulder and say, wait a second, it's not if you're B of A or your JP Morgan, it's not your big US bank competitors that you're worried about, or even European. It's these market-making firms just looking at the growth and the market share that they're taking each quarter.
If I'm Morgan Stanley and Goldman Sachs, do I care I'm losing this share? Am I fighting to keep this share? Is it a profitable business?
Also, how would they fight for it at some point?
So you have to invest. You have to invest in your people and your technology. And yes, they are. I don't know if they're going to broadcast that they're saying, oh, we're worried. I think that most of them would say we're fine and we're competitive. But if you don't invest and put money and balance sheet into supporting these trading businesses, you're going to lose out. And in terms of the big banks with investment banking, with trading, that's a significant portion of your yearly revenue.
So if they don't, so they say they're investing, they say that they're competing, but clearly that must not be the case in some ways if you still have the Citadel's Jane Street getting more and more market share. How do you think that this plays out? Like, who is it more important to?
So the market is also expanding. At the same time that these market makers are growing, the pie is growing. So it's the banks are able to make more money, and these market makers are able to make more money at the same time. Now, the portion of the pie. Will that change so that the market makers over time take more, even as the pie expands? That's what we're tracking, and it does look like if they keep up this momentum, it's going to become potentially a problem for the big U.S. banks, especially those like Goldman that rely so heavily on their trading as their core money-making unit.
Jane Street, Citadel Securities, these are private companies, right?
Yes.
They seem like pretty good businesses here. Do they think about going public anytime?
So Citadel Securities has said that it would be right place, right time is kind of what they've broadcast. Their CEO has talked about their expansion, but he said we're in no rush. It's definitely on their radar, but they're not forced into going public anytime soon. So they would only do it, and they're positioning themselves to go public, but they would only do it when they feel that the market has stabilized, that they would get the best pricing, and there's not as much uncertainty. I would say going into the 2024 election, it's not the best time right now, but I would, after the election, if things look stable, we could see a public offering of Citadel in the next handful of years.
I mean, that'd be huge. I mean, this would be an enormous IPO, no?
It would, I mean, just based on the financials, their return on equity, it would likely be priced competitively, I would say. I'm not the one that I wouldn't be here talking if I was the one doing the financials to see what they would actually fetch if they were to go public. But just looking at the appetite in the credit market, Jane Street and Citadel both have loans, so that's why they're going to their investors, and these are credit investors, to show their growth over time, and just the appetite for the debt that might reflect that in the equity market they'd also be perceived quite positively.
Katherine Doherty, great stuff. Appreciate it. Katherine Doherty, finance reporter, Bloomberg News.
You're listening to the Bloomberg Intelligence Podcast. Catch us live weekdays at 10 a.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. You can also listen live on Amazon Alexa from our flagship New York station. Just say, Alexa, play Bloomberg 1130.
This is Alix Steele alongside Paul Sweeney, and this is Bloomberg Intelligence Radio. We cover all the top news in business, economics, and finance through our lens of our Bloomberg Intelligence folks. They cover 2,000 companies in 130 industries worldwide. Once a week, we also tap into our huge arm of resources over at Bloomberg NEF. It's ticker for New Energy Finance, and they go through and they cover commodities, power, transport, industry buildings, agricultural sectors, technology, sustainability issues. It's all in part of the energy transition, and a big part of that is how we finance that. Well, Trina White is BNEF Sustainable Finance Analyst, and she joins us now on the role that big banks are playing in the energy transition. Trina, how do you measure that, first of all? Because you can make an argument that, okay, well, forget it. If you're lending to Chevron, then it doesn't count, or a big oil company. But those big oil companies also do other stuff in the energy transition. So how did you measure everything along this line?
It's a really great question. The primary climate impact that banks in particular have, it looks a lot different from a real economy company like an oil major or like a steel company. Instead of their operations, it really lies in the deals that they're doing with these companies. So the projects they're financing, the pipelines, the drilling, but also the solar projects and these newer, cleaner companies that they're helping to access capital. And so how we measure this is through a ratio called the energy supply banking ratio. And this is the proportion of the financing that banks are facilitating toward low carbon projects and companies to that of fossil fuels. And your specific question on oil companies is a great point because all of those oil majors are also beginning to make investments in clean. So we'll sort of portion the amount of financing that is going to those oil companies, the amount that is going toward their low carbon projects versus their existing fossil operations.
So I would think most banks, I'm not going to say all banks, but most banks, they bank the energy sector. Everybody's got an energy team. Are they banking both the fossil fuels and the new energy? Are they doing both?
Absolutely. So what we see globally is a ratio of about 73% as much low carbon financing as fossil fuels. So for every dollar going to fossil fuels, about 73 cents is going toward low carbon solutions in 2022. Most of these banks have a pretty diversified portfolio. It really depends regionally. So in Canada, for example, where the economy is super tied to energy exports of traditional oil and gas, we see really low ratios, about 0.3, 0.4. In Europe, where low carbon is much more developed and there's more of these companies and projects for banks to finance, we see a ratio of about 1.8, so much higher.
Are these banks making stuff on the loans to do the green things, or is it, how do they manage that risk?
So these are definitely still profitable deals. They're not making any real concessions. It's really just, are there the companies looking for this financing? Are traditional companies also looking for labeled like green and sustainable debt to raise as well? So there's not necessarily a ton of control that banks have over the demand from this underlying set of companies. So in many ways, it's also an indicator of who their client base is.
So if I'm a banker at, I don't know, JP Morgan and Chevron's my client, I'll underwrite any kind of bond they want. I don't care if it's green or not green, as long as they pay me. But
he's a former banker, by the way, so don't, you know, that's
way.
why he's saying that.
It's all about the fees.
That's what we hear from all our clients too.
So, but I don't want to hold the loan on my books. I want to syndicate it out and syndicate the risk.
Exactly.
Do I feel okay that there are investors out there that want to own new energy debt, for example, or new energy financial instruments? Do people want to own that stuff?
There's definitely demand for it. I mean, we see it with the takeoff of the labeled market, so giving investors visibility into, you know, a bond or a loan that's actually labeled as green or sustainable use of proceeds. But in terms of what we hear from banks, it is exactly that. They follow where the money is. And so in many ways, this tends to be a lagging indicator of what's going on in the underlying real economy.
What other stuff are you looking for within this energy bank ratio, sustainability ratio? Like, what else are you guys focusing on?
So what we would really like to see is both in the banking sector, but also in the underlying real economy, this measure of low carbon to fossil fuels more than quadruple across this decade. So to be consistent with 1.5 degree climate scenarios, so those are models that are put out by the International Energy Agency, for example, indicate that we would need to see 4 times as much low carbon investment as fossil fuels this decade. So whether or not it's, because the banks don't have agency or these underlying companies are not quite raising financing at the levels that we would need to see, we're nowhere near hitting our 1.5 degree climate targets.
Are there certain banks or financial institutions that are doing a better job of financing the green economy versus others?
Like European banks maybe, or not?
There's large variation. Last year, Santander had a ratio of about 2 to 1, just under 2 times as much low carbon financing as fossil fuels. Again, it tends to be the North American, the Canadian, the US, and also the Chinese banks and emerging markets that tend to have much lower ratios.
That in some ways
I'm guessing a bank in Texas isn't doing a lot of green energy deals.
Well, I don't
surprised.
know if that's true because
okay, well, let me ask that.
They have the biggest wind area in the country.
Okay.
Yeah,
that's exactly right. I mean, we're seeing a lot of the new tax credits being claimed in Republican states like Texas.
Really?
And then also they have like more local banks too. So I would wonder. I mean, they don't have more, but I'm saying I wonder if it's exclusively oil and gas. And also to the point that, again, like big oil does do other stuff. So it's just harder, I think, to break it down in a way that makes sense. But they do other things than just, stick something in the ground and get oil out.
Exactly. Even within the oil companies, there's a big difference in how they're spending their capital expenditures on low carbon infrastructure versus fossil fuels. Like an Exxon is very far behind a Neste, for example, which is investing heavily in their renewable fuels.
Interesting. And do they have to get loans out to do that, or can they sustain it with their own cash flow?
Because they were so profitable in the past couple of years, a lot of these oil companies are financing off of their own balance sheets. So we did see a bit of a dip in these large oil majors raising financing.
Yeah, good stuff. I mean, I don't know. I mean, I think I would make a loan. I don't care,
Right, but it has to have the right kind of return. That's sort of the problem, though.
Well, yeah, I can figure that out. I know, but I want to make my loan, take my fee, and then syndicate 90 to 95% of the loan out to other banks. So I just hold a little piece.
Yeah.
So I can get back into the client and say, I still own your paper.
But then what if those other banks are like, ooh, is that how green is that? I don't know if I can take it because then my clients are going to be mad. So
that's why I go to my syndication desk and I say, can you sell this?
Right.
And these banks see the writing on the wall about, how long are they going to be able to do business with these traditional oil companies. And so are those companies that they're doing business with transitioning?
All right. Well, we appreciate it. Thanks so much, Trina White of BNEF. Really fascinating conversation there.
This is the Bloomberg Intelligence Podcast, available on Apple, Spotify, and anywhere else you get your podcasts. Listen live each weekday, 10 a.m. to noon Eastern on Bloomberg.com, the iHeartRadio app, TuneIn, and the Bloomberg Business app. You can also watch us live every weekday on YouTube and always on the Bloomberg Terminal.